Hi, welcome back to another edition of Flippers Fund Flows Insight. My name is Tom Roseen. Happy New Year's to you. Thanks for joining me today. I'll be reporting flows for the week ended Wednesday, January 3rd, 2018. We really kind of had a pretty good week, all things considered, as far as flows week go. Again, starting from Wednesday and going to Wednesday. Obviously we had the shortened New Year's holiday weekend we had to contend with. Thursday we saw really new records for all three indices, and then Friday a little bit of a meltdown as investors were just not willing to put risk on the portfolio ahead of the holiday weekend. But then we got back on track on Monday and Tuesday. And we saw some, or actually Tuesday and Wednesday. Monday we were closed for New Year's Day. But we really saw some really good performance. Semiconductors took off, oil took off, and we saw records from the Dow, the NASDAQ, and the S&P 500. But it was really kind of a head scratcher because a lot of people that were pushing those up also were complaining about a few things that were coming up. And that's certainly, will President Trump turn around and actually start working on the infrastructure development? Will we get that going? And also there was some underlying concerns out in the market as well during the week, and one of them was obviously North Korea claiming that they have completed their nuclear weapons program. And then also we saw that there was rioting going on in Iran, and we saw that there were some deaths going up against protesters getting killed going up against some of the guards of Iran. So a little bit of concern there. And then, of course, on the very last day of the trading week for the Fund Flows week, we saw that the Fed came out with its minutes, and basically we did discover that they are not in unison on doing 3 more cuts and what the pace is for 2018. So there's a little confusion there, but nonetheless, it was a really good week. That said, we actually saw outflows of about $3.7 billion, the second consecutive week that we've seen outflows out of mutual funds. And again, that is ex-ETFs. We'll talk about ETFs as we go. Let's take a real focused look, though, on what happened this week by looking at the macro groups. Equity funds saw about $800 million of net new money coming to their coffers. We saw taxable bond funds taking about $2.9 billion. And then muni bond funds actually had a change of pace, change of heart, about $243 million out. And money market funds saw the lion's share of outflows, $7.1 billion in outflows. Let's take a more focused look now at the flows for the equity arena and see what happened in that group. Basically, if we take a look at it, we saw a 1.42% return. Remember, I told you it was a really good return week. Fourth consecutive week, we've seen plus side performance, and we saw about $787 million coming to the coffers. Second consecutive week, they've seen inflows. However, if we take a look, the economy continues, not so bad as it was. Domestic equity funds saw about $531 million in outflows, while we also, that's the 52nd week in 53, by the way, that we've seen outflows, while their non-domestic counterparts basically saw $1.3 billion in inflows. Second consecutive week, they've taken money in. On the non-domestic side, we saw a 1.86% return, and then on the domestic side, we saw a 1.19% return. So really, it was one of those stories that you kind of said, well, gosh, both groups did good. Why didn't everybody actually just, pull in money on the domestic and non-domestic equity side? We have our hypotheses on that as well. Anyways, large cap funds with a pariah, losing about $655 million. It's been the pace and something we've talked about probably for the last 2.5 years. Global and international equity funds took in money. Global took in about $763 million, and then we saw that the international took in about $582 million. So that was the story there. Let's turn our attention now to ETFs and see what happened in that group. Basically, for the second week in 3, we saw that ETFs had outflows, this time to the tune of $9.2 billion. So the dichotomy that we've always been talking about before, where ETFs were taking in money and mutual funds were not, it's kind of traded places this week. Some of it could be due to just year-end squaring of the books, people actually getting rid of some of their losers, doing tax loss selling. But in any case, we saw outflows, again, $9.2 billion. At the top of the group, as far as taking in money, we saw iShares Core S&P 500 taking about $678 million. And then we saw Energy Select Sector Spider taking about $395 million. Now on the bottom end of this chart, we see SPY, the Spider S&P 500, actually lose about $8.9 billion, and PowerShares QQQ lose about $2.5 billion. So really just 2 funds accounted for more than the lion's share, just about the majority of outflows that occurred on the ETF side of the arena. Let's take a look now at the fixed income funds and see what happened there. Basically, for the first week in four, the first week in four, we basically saw inflows. About $2.9 billion this week went into, if you will, conventional fund fixed income funds, and it's the second week in second consecutive week actually that we saw plus side returns. This time to the tune of 0.39%. We got to keep in mind that the yield curve actually did a little flattening, and so long end of the curve actually benefited. But we didn't see a ton of flows. 2.9 is not bad. Corporate investment grade debt funds took in the largest amount, about $1.4 billion. That's the 31st consecutive week they've seen net new money coming to that group. And flexible portfolio funds saw about $822 million come into that group in the second week in three. At the bottom end, we saw government mortgage funds lose the biggest chunk, about $285 million in outflows. And then corporate high yield funds lost about $192 million. Not a lot to write about there. Let's take a look now what happened to the ETF side of the business. We saw about $398 million net new money come into ETFs on the fixed income side. And basically, it's the second consecutive week that we've seen net new money come to that group. At the top of the group, we saw that the Spider Barclays, actually a Spider Bloomberg Barclays high yield bond fund taking about $478 million. And the iShares Core U.S. Aggregate Bond ETF took about $333 million. Now, if we get to the bottom of this group, we basically see the Guggenheim Bullet Shares 2017 corporate bond ETF losing about $495 million. Well, it makes sense. 2017 was their term trust. So we saw two groups, the high yield and their corporate bond, suffer mass redemptions, but it was a planned mass redemptions. Basically, they shuttered those two funds, and we saw those as outflows. So again, I don't know much about trend there as much as expiration of the term trust. Let's take a look now at muni bond funds. And muni bond funds saw, for the second consecutive week, outflows about $243 million this week. But it's the second consecutive week that's had a plus side returns, this time to the tune of 0.41%. So really a little bit of a head scratcher there. Again, though, this could be just end of year selling as far as squaring the books. And of course, some people were doing some pretty big stuff at the end of the year because of the passage of the tax bill and changing of opinions on how well muni bond funds are going to be able to work in this current regime. So we saw that. But actually, if we take a look at the big loser, it was short intermediate muni bond funds that lost about $159 million. And then we saw short muni bond funds. Again, this is that yield curve tilt. We saw them lose about $101 million. Let's take a look at money market funds now and kind of wind up this session. Second week in three, we saw outflows, this time to the tune of $7.1 billion. How that broke out is taxable money market funds. Saw about $9.6 billion in outflows, and tax-exempt money market funds took in about $2.5 billion. Here was that kind of shift that I was talking about, people kind of parking the money ahead of time and kind of trying to figure out what the new tax bill meant. If we break out, though, the taxable money market fund group, we see institutional investors were the big net redeemers. About $11.8 billion came out of institutional funds, while retail investors added about $2.2 billion. Well, that's it for me today. We had some news, though, today that we had a lower than expected non-farm payroll. It came in about 148,000, and I think most people expected more like 200. I think the consensus estimate was right around 198. But here's kind of the question. During the busiest season, as far as retail shopping goes, we saw a decline in retail sales job by about 20,000. So I'm thinking that the numbers are not right. We'll have to wait to see what the details are, and of course the restatement when they come out with the next non-farm payroll report. But we'll certainly keep an eye on that to see how the market and investors respond to that news. Well, if I didn't do a deep enough dive for you and you wanted to do a little bit more digging, you could go to www.lipperusfundflows.com, or you could join us next week when one of our analysts will talk to you about the flows trends for the week. Thanks for joining me. My name is Tom Roseen. Wishing you the best in your wealth planning and creation.